Hey, what's up, guys, and welcome back to part two of my 10-part series to help beginner traders go from A to Z and actually be able to profitably trade a live account. So, this one is going to be technical analysis 101 for small caps. And for me, this is where most traders stop. When I'm teaching my students, I talk about the three pillars of trading. I got that from my mind coach, Steve Goldstein. And there's the technical pillar, the performance pillar, and the self pillar. And 90% of people, once they understand technical analysis, they just kind of stop. But at the very beginning, this is the thing that just blows your mind. And so it's going to be something that is extremely important, especially for people that have no idea what they're doing in the stock market. So I'm going to take some time with this and try to explain as much as I possibly can in the next 40 to 60 minutes, and hopefully you guys find a bunch of value from this. If you guys do, please like, share, subscribe, all that good stuff. And wherever you guys are watching this, if you guys have any comments, comment down below and let me know if you have any questions with anything. I'm more than happy to help with anything you guys need help with. So, welcome to Technical Analysis 101 for small caps short sellers. This webinar will equip you with the fundamental technical analysis skills to navigate the small cap market as a short seller. And like I said before, that's what I trade 90% of the time. Is I'm 99% short bias. So that's what we're going to focus on in this. So introduction to technical analysis. Technical analysis is the study of price action and volume to identify patterns and trends in the market. It's used historical data to predict future price movements. And what I mean by that is, in the past, if you see something on the daily level, how I teach all my students is you always start on the bigger picture. What's the daily look like? Is there any points of resistance or support in the past? Because those are going to be key levels, and they're going to affect price action in one way or another. Price action refers to the movement of a stock's price over time, including highs and lows and closing prices, and that's going to be what the candlesticks, which we'll be talking about here in a second, and then volume. This is really all I use to trade. I use daily key levels, price action, and volume. That's all I personally need to be able to make a good trade. And volume indicates the number of shares traded in a given time period, revealing market sentiment and the strength of the move. And that means basically, if you're on a 1 minute chart and you see a million volume on the 1 minute chart, that means a million shares got traded in that 1 minute chart. You switch over to a 5 minute, it's gonna there's still gonna be 1 million, but it's also gonna add in however many minutes are in that 5 minute candle, and it's gonna it's gonna bunch all that volume together. So that can be a very, very good indicator on reversals or times for you to get the heck out of the stock, because at the end of the day, volume equals demand most of the time. What I'll talk about here in a second is some of the times where I use volume to show me when I should be getting in, because there's way more supply, aka a big hand or institutional dumping a bunch of shares into the open market, and the volume goes up but the price isn't going to go anywhere. And that's a more advanced webinar, which I'll be doing down the road. But in this basic beginner webinar, I'll go over all the absolute basics you guys need to get started in the stock market, but you can go really super in depth with price action and volume. Chart patterns, identifying key formations. Chart patterns are reoccurring formations in price action that can signal potential price movements. Understanding these patterns help identify potential trading opportunities and manage risk. Head and shoulders is a very common pattern. You'll have a chart where it goes up, kind of goes down, it goes up and finds a new high, and then goes back down, and usually the right shoulder is either at the same level as the left shoulder or a little bit higher, and it's all held up by the body line. And once that breaks, it done deal. Double top is, I'll show you an example here in a second. Cup and handle is a good signal to get the heck out of a trade if you're short. And then fake breakout, that's kind of like my bread and butter right there. That's where I look for. I'm looking for where people are being super greedy and where their fear kicks in. That's where I feel like that's where my edge is I look for fake breakouts. That's out of all these four, that's my absolute favorite is a fake breakout. So, and we'll go into a couple of different examples of these here in a second. But this is a breakdown of a candlestick cheat sheet. So I don't want to see this. I don't want to see the hammer. That for me, it shows that either somebody's covering a big position and or somebody's buying. But either way, when you cover a position, you get out of your short position, you are going long. You are buying the share, and so I don't want to be seeing this, especially before any of my targets are hit. I want to make sure that my targets are getting hit. These are kind of the bearish reverse signals are things I don't want to see. I don't necessarily see this one all that often, or this one. I do see this quite a bit. I do see this, especially on like the 5-minute chart. I'll see these kind of things going on. But what I am looking for a lot of is this. I love this. And usually what I like is I want to see, say, the level that I'm looking to trade at. I want it to be, say, right here. And how I personally trade, this is my favorite thing, I do it all the freaking time, is I want to see this thing pop up. The second this pops up, whatever this number is, say it's $3 to make it nice and simple. This goes to, say, 307. I'm already looking at the bid, which I'll explain in future webinars. I'm already looking at the bid. I want to see the bid slamming back down really, really fast. Really fast. Back towards $3, I slam the bid. I'm instantly risking the high up here. That's one of my favorite moves. I got shaken out today, which I'll show you a chart that I traded today that had a double top, and I didn't get into it, and I'll explain that a little bit more later on in this webinar. But one that I have been seeing a lot recently is this one right here. So you have a big red candle, and usually it's on the exact opposite thing. Because what a lot of beginner shorts will do is say this is like a key. Well, that wasn't very good, Adam. Say that this is like a key level, right? And what a lot of beginner shorts will do is they will short the breakdown. So the second that this thing fails under here, they're all slamming the bid. Well, you might get covered when you slam the bid. That's the weakest point that you can get in a trade. You instantly get filled, but depending on where the bid is, you can get filled anywhere in here. Well, then like it goes down and then it double bottoms. And then it starts to come back up. If I see this big red candle, if it gives back more than half in the next two candles, I'm probably looking to get out. Like this is a signal to me, like, oh hey dude, this might not be the best idea. Another thing is like this doji. This doji is any of these show. Well, indecision patterns. It shows that, the market is, especially this, depending on if you're going up or you're going down, you start seeing this or this or this, it's a very good chance that there is going to be, a reversal, a potential reversal of whatever it is. If the stock is, going up, see how artsy I can get. Actually, bear with me. This might be a disaster. I'm not an artsy kind of guy. So if the stock is going up, has a little pullback, going up, pullback, up. Well, you've been, scared to trade here. You're like, oh, I missed it. Then here, oh, I missed it. And you're like, all right, this next one, I'm gonna get it for sure. I'm gonna 100% get into this thing. All of a sudden, this thing pops up like right here, and then this doji happens right. Well, really, this doji happens right here. That is probably a very good indication that either you're gonna trade sideways, or you just found a top, and then it's gonna break this previous support level. And it's not 100% on the whole time, but it's just, hey, be mindful and make sure that your risk is accurate where you need it to be. So here is a couple of different examples. I'm gonna see if I can zoom in on this. Bear with me, I'm still getting used to this. So well, I didn't really zoom in that much, but so if you see green candle, and then all of a sudden it pops up over here. This green level is a daily level. It pops down and slams right down. I'm taking a short, risking 235. So I'm in at 230, risking 235, whatever your dollar amount that you're willing to risk. And all of a sudden, this thing just has a crazy long. It pops a little bit, right? Pops 2 cents, and then all of a sudden it just slams down on high volume. What that shows me is that a big hand, it doesn't have to be an offering or anything like that. That's a very good place for a offering, but somebody that has a lot of money just dumped a ungodly amount of shares into this thing because somebody somewhere is telling all these people to buy this stock and it's going to go to the moon, and they have no idea how small caps work. And but the thing is, long red candle, and then look at the volume, right? This is why I only trade with chart patterns and volume, because when you start seeing the volume just die, right? This thing's trading with almost, for however long this is. I don't know how much. Do I have more of this? Yeah, I do. All right, perfect. That's great. So this thing is trading at, I guess it's only like 5 minutes, right? For 5 minutes, this thing's just pumping out an ungodly amount of shares, right? And then all of a sudden, it just dies off. And I mean, it's still trading good volume, 1 million shares, but the difference is there's millions and millions of people either short on the stock, which is pushing it down, or they're trapped long at $2.30. Within 2 minutes, this stock is down under $2. If you're only in with 100 shares, that's not, crazy big. That's $30. But I mean, really, how many of you guys are willing to stay in a trade if you're down $30 or $40? Like, you start thinking about like little stuff, and you're like, hey, man, that's now with the way the market is, like that's a nice, good, juicy steak, or you go in with 1,000 shares, that's $300, and then you're like, oh man, dude, that's the power bill, or the power and the water bill, and you start worrying about a lot more stuff, and then you start panicking. Well, then you start selling, and it starts dropping even more. What you want to make sure is this: if you're a short seller, you want to make sure that the volume stays low. If the volume stays low, that means that demand is low, and when demand is low, that means the stock, unless it's being manipulated like a lot, it should not go back up. And so that is how I use price action. I look for chart patterns to get me into a trade. Once I'm in the trade, I want to make sure that it happens instantly. For me, the way that I like to trade, I'm not looking for this thing to kind of hang around. I like to try to be a sniper, um, get in, and right when I get in, it should react the way that I want it to. If it doesn't, that means that something's wrong, and I need to be watching for chart patterns that I've noticed over the years that indicate a possible reversal, and I get out, which reduces my risk a lot. Because every time I get into a trade, I am always risking, X amount of money, here. My risk is on, right? This thing goes down, it covers. I'm not risking up here anymore. Whatever I have left is break even. But, which you'll see here, like with my example later today, if my first target doesn't hit, I'm not risking up here if this thing goes, 30, 40 cents in my favor, because that's a good chunk of money. I'm not gonna turn a big winner into a loser, because that is going to trigger me, and I've learned that from years of experience. So this is another very good indicator, right? So like I did on this one, let's see, this is at $1.36. This must have been either a daily level or the pre-market high. Yeah, it was probably the pre-market high. Got in here, but my first target didn't get hit. Well, it starts finding a bottom, and then I can start seeing this curl. I'm not risking this anymore. Why? Because I'm in it. 34. It got down to, I'm almost 30 cents in the money. I'm not going to take something where I was up 30 cents for every share that I was in. Like I said, if you're trading with, say, $1,000, that's, or 1,000 shares, that's $300. I'm not going to be up. I'm not going to be winning $300 or whatever your dollar amount is, and turn that into a loser, because that's going to piss me off, and it's going to make me go on tilt. So I cut this off. Then once that happens, my trade's done. Now it's like, okay, I have certain plays that I have. I have a gap and crap, pop and fell, pre-market high, and I have a gap and extension. And for me, on day ones, those are my plays on day ones. So for me, I needed a gap and extension. And so this thing gives me a signal for a gap and extension. I take a trade. I'm risking just over here. It comes down. It started. I missed my first target because my first target wasn't there yet. It started bouncing up. I was like, hey man, I get closer back to this. This thing's acting crazy. I'm gonna cover 3 cents over my target. Okay, I lost 3 cents. Whatever. Covered. Now my risk is break even. Whatever happens, whatever. Well, since this is not, I covered a little bit early, I decided that I skipped my second target. I covered my third target. Now my final target is down here. It didn't hit, but I don't trade after hours. I covered right here, and I just call it a day. Once I cover, though, there's a thing that's called a range order, where I can set out, say, if I know I want to cover at this area and I want to cover this area, I can set out orders to cover half here, or 3/4 here, and 1/4 down here, and both of them are break even, or 2 cents in the money, or however you want to play it. That's a way that you can trade, and that's a way that I trade a lot, because I have a full-time job. I basically work for a family business, and I get to trade stocks while I'm at work, but I don't want to be here all day. Even if we're slow, I still don't want to be babysitting stuff, because it's boring as hell, and it can mess with your emotions. And so I would much rather just set a range order, and that's my personal preference. But that's just how I play it. Actually, I'm gonna go backwards here in a second, because indicators. I have students that use all sorts of indicators. For me, the only thing I use indicators for is targets, and sometimes rules, because if by a certain time my first target is not hit, then I might just leave the stock alone, depending on how it's moving and what it's doing. Technical indicators are mathematical calculations based on price and volume data. provided additional insight. That is true, but like for my targets, um, this blue one, this is the average of X amount of these candlesticks. It takes the average of the last 50 or 60 or whatever my things are. This is my first target. It takes the average of that, and so when it hits this, okay, like now how's it going to react, and that's something that I track over the weekends, and that way I can see if the market is shifting or not. But they're targets for me. This is my first target, my second target, my third target, and my last target is right here. And that's just how I do it. And when they start coming down and start crossing, that shows me that this thing is dying. It doesn't have a lot of strength, and then it gives me confidence to stay in it. That's how I use moving averages. But people have all sorts of things like Bollinger Bands, VWAP, Bookmap, Footprint. There's a million different things, and my personal opinion is that's because there's so many different personalities. There might be something that you like to use that fits your personality or catches your eye and makes sense to you. Okay, cool, use it. But for me, they're just targets. That's all I use it for. They can be good for identifying a uptrend. Like for me, if you go back to my targets and they're super spread out, that means that it's in a very, very strong uptrend and it's in a shorter time framed uptrend. Especially if my first target, my second target have a huge difference between them. That means that this thing is made in the last little bit is made a huge spike in price, which can be a good thing for me or a bad thing depending on the price action, the volume. Is it SSR? What's the float? There can be a lot of different things that get plugged into that. But an uptrend is a characteristic, just kind of like I drew out before. An uptrend is where you have higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low. This is a low, this is a new high. This low is higher than this low, so it's going up. It's uptrending. Then it breaks over this. It continues on up. Then it goes down, breaks over this. It's still uptrending. Then in the reverse, you're going to have something that goes, well, that's kind of shitty. Down, up, down, up, down, up, down. You get the idea. Like I said, I'm not an artist, not trying to draw anything, beautiful, but that is an uptrend. One thing that I do pay attention to a lot though is the sideways trend. And the reason for that is the sideways trend that can be a accumulation, and especially if it's going for a long period of time, I don't want to see sideways action. When I get into a trade, I want to see a uptrend. I want to see this thing just going straight up, up, and then all of a sudden it has a fake breakout, and then the second it takes that, it's a woof. It's going straight down. I don't want to see any sideways action or anything like that, because sideways action means that it could be trapping, beginner shorts, and it's going to squeeze or something like that, which is what we went over in the first webinar. So that is not something I'm looking for. Volume is the key, because I love volume because like I said, it's demand, but it can also be supply, because when you go up, when you're getting to a level, especially after something's stuffed, if you see that this thing it's almost like the candlestick pulses, right? Like imagine this is kind of like a candlestick. Imagine this has like a long wick, right? And say this is my daily level. So if I see this thing keep on bouncing up and down, up, down, up, down, up, down, up, down, up, down, and then all of a sudden I just see the volume just, skyrocketing. Like it just starts, it's, trading right here, and all of a sudden at the bottom of the chart, you just start seeing it rising. I'm like, dude, that shows me that there's a lot of people buying this, but somebody's selling into them. And I like that because that tells me that whoever bought above this point is in a lot of trouble. Because if the volume is still rising, it's below the daily level, and every time it tries to push up, something slams it down, slams it down, slams it down. That tells me that somebody's order is getting filled, and that these guys are all getting trapped. Well, then what happens when the volume, when the demand goes away? The stock tanks. It goes down, and for me, that's a great thing because that means I made money, and that's just the shitty part of the game is when you look at a stock, there's somebody in that transaction, somebody is selling and somebody's buying. That doesn't always mean that there's always a loser on, that's what I was going to say, but that's not necessarily true. But there's probably somebody that's not, especially in those kind of circumstances, there's somebody that is in a lot of pain, that is like, oh my God, I just that's my entire savings account. That's my, whatever. And it can suck, but you either you give up and you're like, this is rigged. Yes, it is. It is 100% rigged. But if you learn how to play the game, then you can find where these guys are rigging the system, you can get with them and win with them. And how I explain to my students is, you want to imagine like you go out and buy like some just amazing juicy steak, right? You're sitting there eating, and this happens all the freaking time. How many times do you see a fly come over and like try to like get a little piece of your steak? It just wants to taste, and you're like, dude, like that happens 1, 2, 3, 4 times. You're each time it happens, you get more and more pissed, and then I don't know how everybody else is, but this is how I am. I will literally sit there and I won't take another bite of my it pissed me off, and I'm like, that thing's gonna die. And the second it comes down, boom, it's dead. And that's how the stock market is. If you overstay your welcome, you're a fly. You're just trying to get in, you're getting your piece, you get out, you log off. Where you get in trouble is when you start getting greedy and you overstay your welcome, and you want to learn the game and get your piece and focus on the process, not the money, because once you can understand how to trade, then all it is, it's just numbers. You just add an extra zero and you go from trading 100 shares to 1,000 shares, and well, okay, now you're making money. 1,000 shares of 2,000, 3,000, 4,000, 5,000, whatever your number is. That's really all the game is. But to go back to the technical thing, this is one of the things that cuts up a lot of beginner traders. Whenever something gets close to the final target, for me, it's dead. The only way I will trade this is, if it has to just rip a lot like this. But I didn't trade this one because it was getting close to the $4 area. And so for me, my line in the sand was right here. I wanted it to do what it did here, there. It didn't, and so I didn't take the trade. I was just like, all right, whatever. And at the very beginning of my trading career, that used to kill me. And, I would do stupid stuff like, I would miss the trade, and then I started jumping in here, or jumping in here, or jumping in here, or, jumping in like way the hell down here, and It's stupid, man, because how I explain it to my students is, and I'm pretty sure I did this in the last one. You want to think of this is the ceiling. This thing just hit the ceiling, bounced its head off the ceiling, and started falling to the ground. This thing just hit the floor and just jumped. You want to be as close as you possibly can get to the ceiling. If you are shorting, if you are longing, you want to be as close as you can to the floor. That gives you a high risk reward. When I was younger, I used to trade down in here. What in the hell am I doing here? Like, this is, yeah, it's up a lot. It's up from $2 to $4. Yeah, that's great. But why would I be taking a trade at $3? That's right in the middle. What am I going to risk off of? And the big money, the smart people are up in here or down in here. What happened up here is probably these guys that start buying in here and pushing this thing up. They're selling their position. They probably sold a little bit here, sold another little bit here, and they're buying on dips to move the market, and they're selling their shares because it doesn't take a lot of money to move the market of a stock that's trading at sub $4. So that's just my 2 cents. So let's see. Risk management. This is something I cannot stress enough. Risk management. And if you do not know what your entry should be or where it should be and what your risk should be every single time, you are straight up gambling. And there's no other way to say that. Risk management, applying technical analysis to short selling. Technical analysis provides valuable tools for managing risk in short selling. By identifying potential support and resistance levels, aka ceilings and floors, traders can set appropriate stop loss orders to limit potential losses. Like I said in the first webinar, everybody that's a beginner, you should just make it super easy on yourself. Depending on the stock price and how much range, which means how much the stock can move, you should have a predetermined stop loss, like a 10-cent risk, 20-cent risk, 30-cent risk. You're going to be trading with such small size, you probably are not going to want to go over that, or having like a higher risk or a wider stop, so that way it gives you a little bit more wiggle room. You're going to win more because you have a wider stop, but you're just not, your risk reward is not going to be good. You might risk, $50 to make $50 or $60. Well, as long as you have a high win rate, a really high win rate, I mean, that can work for you at the very beginning, and then you start getting your feet wet, you start dialing that risk down a little bit. But you should always know exactly what you're looking for the entry point. What does your entry point look like? Determine a clear short entry signal based on chart pattern indicators. Like I've been telling you, the volume, daily levels, stuff of whole $half numbers, lower highs, however you calculate that in, and then always have a stop loss order. That way, like when I first started trading, the second I got in, I had a hotkey that automatically clicked in, and it was supposed to help me with my emotions. Right now, I'm going to tell you right now, there is not going to be anything that's going to really help you with your emotions. It's just going to take time and experience. But it can definitely help negate a lot of big losses, because the last thing you want, remember how I was talking about the pain? You don't want to, especially a short seller, because you have unlimited risk. When you buy a stock, what's the worst that's going to happen? It goes to zero. Well, 9 out of 10 times it's not going to actually go to zero, because if it goes to zero, that stock is it's done, right? How many stocks do you know that actually literally go to zero? I don't know of any, honestly. But there can be a stock that goes from GameStop in the last one that I talked about. It went from $250 to almost $500. That is insane. You don't want to be stuck in something like that where you're like, obviously you're gonna get taken out by your broker because nobody's gonna have that much funds, but you can blow an account, and that could a knock you out of the game to where it takes you a long time to get that money back, or it just knocks you out of the game permanently, and you don't want that. You also need to have profit targets. So every time I start working with someone, I'm like, okay, my system, and if you start working with me, your system is going to be, I tell you exactly where your interest should be. It needs to look like this, be in this area, and this needs to be happening for you to take an entry. Once you get in your entry, you know what your risk is. Your risk is the same thing every single time. Every single time. Your targets are the same thing every single time. It takes a lot of emotion out of trading, which is something that is very, very, very important at the very beginning. Then gather data. Applying technical analysis in the small caps market. Data illustrates how technical analysis can be applied in real world scenarios to identify shorting opportunities in the small cap market, or tell you where, how many of your trades worked, what targets got hit, what time of day, how many of these stocks are, being a multi-day runner. There's so many different things you can plug into this that will help you have an edge. If you don't have an edge in trading, you're not trading, you're gambling. Gather market data. Collecting reliable data market from reputable sources, including price charts, volume figures, and financial statements, is crucial for making informed trading decisions. I cannot stress this enough, because at the very beginning of my trading, I didn't track anything at all. You have to track, or you have no idea if the market shifts. At the very beginning of my trading, everything just died. It was the stupidest, easiest way to make money. When I finally learned short sell, I was like, holy shit, I'm going to be rich. This stuff is so easy. And I started sizing up. Well, then COVID happened. And then that stuff, the market changed because I didn't do any of this stuff. I had no idea why my setups weren't working. I didn't have enough experience to understand, there's a lot of people in the stock market right now because everyone's sitting at home. And the volume, I never seen volume like that in my life. And I was just getting my ass kicked. Well, it's because I didn't have a clear-cut plan. I didn't have data show me, hey, these things should not be pumping out this many shares. These things should not be still uptrending at this time of day. All this kind of stuff. Analyze historical price trends. Identify patterns and trends in historical price data to gauge the strength of a stock's price. What did it trade like in the past? Does it have any past? For me, that's called a recent IPO. If there's something that does not have any data, how can you trade that? It doesn't have any previous levels. It has no history. It's like, I don't know. It's like going on a date with a girl. You're not going to go on a date with a girl and trust her with your credit card and your everything on the first date. You have to have history, or you have to know of people that know the girl, or something. There has to be history so that you can trade off of a stock, because that's just insane. Like you're gonna blow so much money. Then monitoring real-time market activity. Tracking real-time market activity such as volume changes and price fluctuations to gain insight into current market sentiment, which is what I went back to how I got my face ripped off during COVID, because I wasn't doing any of this stuff. What I prefer to use is Edge to Trade, and this stuff is absolute gold. So I have it set up very easily for me. Every morning that I get on, I have a gap and crap. It shows me what stocks have found a topping in pre-market, are trading below a certain level, and these are like the easy moves. These are all of the gappers. These things could be anything that's over $1 or has gapped over $1. It shows how much they're up and the more the better, because the higher the gap, I generally don't trade anything that's under 30% of a gap, because that gap is what makes you money in small caps. You need to know that. Then it also has the day one. It shows you how many times this thing's gapped up. It shows you the average gap price, the average gap percent, how many gaps closed green or above. Like if the price opens at $2, how many of them close above $2 or how many close below $2. On this one, it has one that closed below $2. Shows the average high of day, average low of day, average spike, low spike, the range, the average volume, which is a really big thing, and then all this stuff, the market cap, how many shares does it have, and what's the float, the short float, the institutional ownership. Like this, for me, I would not touch this. Like, you could not pay me to trade this stock right now, because it's got one gap stat, it's got 82% institutional ownership. This thing, OKLO, I would literally be going over to this thing, right clicking on that, exclude from gaps. And that's what I do every single morning. I literally go in, I can click on it, it shows me what the chart looks like in real time, it shows me all the stats, and I start going through and I start, don't like this, don't like that, don't like this. I did like this actually, IMRX, I remember that from, and BBLG. I don't know what any of these are, but Edge to Trade is really, it's probably one of the best things ever. And I know the owner, he's a super cool dude. He helps people in my community out. In this video, I will be putting a link down in the description. If you do want to test this out, I have a discount link to use this product, but really, this thing is the easiest thing in the world. You can also go through the financial statements, the filings. It shows who the insiders are. You can go back in the history and see what it's traded like in the past. There's so many cool ass features, and really, I got on a call with him a couple weeks ago, and he's got so many more new features that are coming out. But you need to do this kind of stuff, because you need something that gives you an edge, which, like I said, Edge to Trade. It's really a catchy little name, but it's such a remarkable thing to be able to just get on, and within seconds I could be like, there could be like an alert or something, and somebody's like, oh hey, this is going crazy, it just shot up 40%. I can get on here, and within 20 seconds I could be like that, okay, in, boom. And then I know where to go and what to do, and because I have a lot of experience. Then the other thing is my trade from today. So let's go up here. So this trade, this level is what I wanted to get in at, was at 150. So the price action, it opened the pre-market high, which is one of my plays. I'm giving away a big secret here, but I took a trade right here, right? So at the open, it was still had quite a bit of shares. It was also SSR, which is something that short seller restriction. You can only trade on the ask. I'll go into more detail in a future webinar on that, but I got in here. I didn't like the price action. I instantly got out break even. This thing just ripped up. I got in right when it stuffed out. There was a daily level at $1.59. I got in. This thing just tanks, and then it halts, which means that it had too much volatility, that it stopped trading for 5 minutes. For me, in my head, I was like, oh, okay, cool. This thing's just it'll hit my target. Well, then it held. Remember how I trade, I'm risking, the high or over this right now. I'm in full size. This thing goes down. I haven't covered anything, which is something I need to start tracking, because if you think about it, I'm in at almost 160. This thing went down to like 115. So I'm like 50 cents up on every single share that I was in, and I didn't cover anything because my target was here. At the same time, in my mind, I was going to cover everything here. Why? Because at that time, these were all really really close together, and really this was actually down farther. It was probably like at $1, so it was still off by quite a ways. In hindsight, I probably should have shaved off a little piece here, really, and just not been, I don't want to say greedy because it is my rules, but that's something I need to really kind of do some soul searching and reflect on. But anyways, this thing starts coming up, and I was like, nope, I'm out. I got out, and this thing just rips, up halts. It halts up, and I was just like, all right, well, where's the next level I want to look at? I wanted to get in near no, because it was like it was down. This was a valid trade. It ripped up. I got in short, but then it starts to hold. And really, what I was looking at was this. It looked like it was forming a D pattern, which means it's got lower highs and it's got a floor on it. And usually, like how in the past at least, which is why I kept my risk on. Normally, what they do is they pop this up, they stuff it, and then it slammed back down. This was probably about a year ago. That was like a big thing. Maybe a year and a half ago. I don't remember. Well, I should have seen, I don't know. Like really, it really wasn't that bad though. And I did cut off before the risk, and I told myself I want this thing near $2. This thing popped just shy of $2, slammed down. I took another short, and then it halts again. Well, then it starts curling. It goes back up, and I cover. I told all my members, I was like, hey, the only way when this is in a halt, I was like, this is my last attempt. And actually, I wonder if I could pull that up to show that I wrote that. 1 second. Yeah. Right. I don't know if this will let me do this. But I told my students that if this did not work, that I'm done. I'm going to if this doesn't work, my last attempt will be at a stuff of $2. This should have died by now, but I am not babysitting all day. I took roughly a 1 hour loss. I calculated in exactly how I'd trade. I told myself and my members, I'm not trading this unless it gets over $2. Well, it did a double top from the candle stuff from earlier. Well, then right here is a play for me to trade. Right at the stuff, look at that doji candle. My white candles are normally green. I prefer it like this. Makes it easier for me to see stuff. Imagine these are all green candles. Doji candle right at the level that I would want to trade. Perfect trade. And, I turned it off. I was like, I'm not even watching this. It's going to piss me off. And so I just left. But I took 1, 2, 3, 4 trades, and I lost 1 R. That's pretty damn good. The thing is, you need to learn price action. You need to have discipline, and you have to have a very very precise way of trading. The only thing that I am kind of slightly disappointed in, really, is this trade right here. That's the only one that I'm kind of, and really, I probably am going on tilt a little bit right here. But if I did not take this trade initially, I would have absolutely taken this trade. I probably would have taken it right in here somewhere, and because it's still trading pretty high volume, which is another thing. SSR, high volume, low price stock. I really probably shouldn't have been trading this at all. And that's something that you start tracking with TraderView. That is the last thing that I'm going to really talk about. That this is so freaking important. Not only does it track, you can plug in all of your trades on this. It'll show your P&L. Are you uptrending? Are you downtrending? What are your stats? What's your average winning trade? Your average losing trade? What's your win percentage? And really, this is something that I do with all my mentoring students. I make them send me all their stuff every week. All right, hey, how'd you do this week? How'd you do last week? You have to look at things on a weekly level, on a micro level, and then a macro level of month and year, and start building this stuff out, because this is a business. And this is something that I highly recommend. I have started to put my charts and all that kind of stuff in there also, but I also like to use Evernote for that kind of stuff too, though. But that's really it for the webinar. The only thing that I can really say is that I would highly recommend that you guys learn price action. Go and study some books. There's so much free information on YouTube. I'll be putting out more information. And if you guys have any questions at all you guys gotta do is comment in the comments down below from wherever you're watching this, and I'll be more than happy to answer the questions. And it takes a lot of time, and you need to really start diving into this stuff. We're going to go into a lot more detail of a lot of different things. We'll even go back over some of the stuff and talk about, like SSR is a big one, or micro floats or recent IPOs, like the lingo, so that you understand. You don't just hear the words, but you understand what does that mean, and why is that good, or why is that bad, or whatever. And that's going to just help you grow as a trader. So if you guys like this stuff, like I said, please give it a like, a share, subscribe, and I'll see you guys in the next one. And I hope you have a great night, day, or evening.